and we're recording the Treaties webinar. Excuse me. Again, what we will be covering is just treaties. If I haven't said so already, always read the treaty. If you think there is any chance whatsoever that you might have a treaty involved, you really need to read the treaty. There are a couple of key topics for tonight. The first is residency tiebreakers. Typically, with a treaty, you have to determine who is a resident so you know whether they get treaty benefits. Treaty benefits simply means they get reduced tax rate or limits on taxation under the treaty. For corporations, there usually isn't a tiebreaker because the rules in the treaty almost always specify only one possibility. For individuals, though, they could potentially be resident of more than one place under the treaty. So there's a tiebreaker rule. The typical tiebreaker rule says a person is resident where they have their permanent home. And if not that, if they have a permanent home in both places, then where their center of vital interests is. Now, U.S. regulations have both of these, by the way, in determining residence. Center of vital interests is referred to as the closer business and personal connection in the regulations. So these are the same in most of our treaties, and in fact most treaties worldwide, as they are in the U.S. tax regulations. The next one is habitual abode. If you've got a permanent abode both places and center of vital interests neither or both, then you go to habitual abode. Then some of the treaties, pretty fair number of them, then default, if you don't have a habitual abode in just one place, they default to where are you a citizen or a national. So this tends to resolve the question in well over 95% of cases for individuals where you have dual residency. Remember, this is a provision of treaties that's designed to override U.S. tax rules. Excuse me. The treaty is in effect modifying U.S. tax rules. Now, this doesn't have any effect on a U.S. citizen except in determining the source of income of certain property. A U.S. citizen is going to be taxed on their worldwide income regardless. And I don't believe, but with 68 of them, I can't tell for sure, I don't believe any of our treaties change that. Now, how do we go about determining these things on a practical basis? Well, I like to ask the Steve Fox question first. There's nothing in writing any place except on this slide itself that says this question has any relevance. But where does the family dog live? The reason I ask that is that usually determines where the person lives. If they've got a pet, except maybe a goldfish, if they've got a pet, where does the pet live? Because that's where they live. Now, some pets travel with them, especially Floridians. The Floridians, sorry about that, Floridians tend to travel with their dogs. So we won't get into that. Ask personal questions, because this is a very personal, individual sort of thing of where do you live? Where do you have a permanent home? Where is your center of vital interests? Where do you vote? Where's your driver's license? If you've ever been through New Jersey residence audit, then you've probably seen some of these questions being asked by the state in writing. Now, for income tax, federal income tax, this isn't domicile, it's it is residence, and domicile is something different, and that's applicable for estate tax. Domicile is where you intend to die. So we're not going to go there. I'm too old for that, literally. Next topic I want to talk about on treaties is permanent establishments. Now, one of your assignments is to read the OECD commentary on permanent establishments. And in that commentary, it's kind of lengthy, by the way, and it's gotten longer in the latest version. In that commentary, the OECD discusses in great depth the theoretical aspects of permanent establishment. You really need to read that commentary if you're dealing with treaties, because permanent establishment is one of the keys to the existence of a treaty. A country does not get to tax the business profits of a company resident of another country or an individual resident of another country unless that company or individual has a permanent establishment in the taxing country. And permanent establishment is simply a fixed place of business. Now, those are the key things, and I've talked about those in the video. They're three. Did I say three? Three different tests there. Fixed place and business. And they're three different concepts. You have to meet all three to have a PE. Now, you read the treaty, and the first thing they do after saying have a fixed place of business is say including, and then have this big long list. Well, these includings are not an exhaustive list. They are items that are prima facie evidence of a PE. If you have one of those, unless you can prove otherwise, then you do have a PE. If you don't have one of those, you can still have a PE. So they're prima facie evidence of what is a PE. Now, a lot of countries have tax treaties that use place of management as a PE. Well, the U.S. doesn't have that in most of the treaties. And the reason the U.S. doesn't have that is we have a little broader concept of what doing business is. And our internal law concept incorporates just about everything that is in PE to begin with. So when does a PE start? Well, it's when business starts at that fixed place. From day one, not at the start of a tax year, not at the start of a calendar year, from day one, whatever that day is. And business may not be generating revenues. It may be things designed to generate revenues, such as your salesman makes his first sales call, doesn't sell anything, but he tries to. A really interesting question arises of, does internet presence create a PE? And the US is a lot further along than virtually every other country in trying to resolve that. And the key word here is trying. We've got some regulations on software, and nobody else has gone that far. So, we have a long history of looking at this issue, and we've got the history because we have states, and there's a Supreme Court case that deals with state tax that goes into what's effectively the PE issue in the 1950s, called National Bellis Hess. It was a mail order company. And you say, well, what does that have to do with international tax? Well, it has a lot to do with it because it discussed all the same issues. And the states have tried to litigate that again, and they tried in Wrigley, and they tried in some office supply outfit that won't come to me at the moment, 20 years ago. And they failed every time because the Supreme Court got it right. You have to have some physical presence to create a PE. There has to be a place. And a place means some geographically distinct location. Having a website, it doesn't have any geography to it. That's the whole idea of a website, is it's devoid of geography. But what if you have your own web server in the US? Well, if you're a foreign company that's trying to avoid US tax, or if you're a US company trying to avoid foreign tax someplace, my advice would be don't do that. You can get web hosting services just about any place, and you can rent it out. If it isn't your own, and if you're time sharing it rather than having something dedicated, then you avoid having a PE. Now, PE only includes doing business. Auxiliary or preparatory activities don't count. And in a moment, we'll talk about 3 court cases on exactly that. Before we move on, though, I want to mention something that's new with Canada, our biggest trading partner, and has been around for a while with India. That is deemed permanent establishments. If you have employees in the US, if you're a Canadian company and have employees in the US on any part of more than a certain number of days in the year, then you're deemed to have a permanent establishment in the US. And there's some limitations on that. For India, the number of days is even smaller than for Canada. For India, it's only 90 days. So if you're doing a service business and one of, say, a software business, and your software engineers travel back and forth here, and one at a time they're on a bunch of different trips, not the same person. No one's here more than 2 weeks at a time. But you aggregate more than 90 days of 90 man days or woman days of presence in the US during a tax year, then you're deemed to have a PE in the US. Now, India put this provision in a lot of years ago, trying to get US companies to pay India tax, and now it's kind of backfiring on them. So, what goes around comes around. So let's talk about what is doing business. Doing business, well, first, there's no PE unless you're doing business, period, full stop. You have to be doing business to have a PE. What's doing business? Well, in Tax 1, your very first tax course, you learned about this because you learned that in order to deduct expenses on Schedule C or E, you have to be doing business. Otherwise, those deductions go on Schedule A. There are over 1,000 court cases on this and rising. And they're the same cases that apply in the international area.
You've been staring at that for a while?
So we got somebody with a mic on, and anyway, agents can create permanent establishment, and that's why we're going to talk about agency in the second half of tonight's webinar. Sorry for the shadow here. I copied this from another presentation, and the shadow ended up here. So what is a trade or business? Well, there's some court cases. They're antiques. Every one of these cases is older than me. They're real antiques. Linen Thread Company had a few sales during the 30s and 40s in the US. And that few sales of thread, few cases. Now, a case, by the way, back then was more like a shipping container. So they had a few containers of thread. And the tax court held that this was not a PE, and therefore Linen Thread Company was not taxable in the U.S. European naval stores sold a lot of stuff during World War II to U.S. customers, another UK company. And it didn't have any place of business in the U.S. It was, it had salesmen traveling around, but they didn't stop any place, then they left. They'd stop at customers and stay in hotels. So there was no place of business, so there was no PE. Then Scottish American Investment Company during the 40s had an office in New York with about a dozen people in the office. But the office was a clerical office. It kept track of investments. No trading decisions were made there. The London head office did all the decisions on what investments to buy and what not. And this was not a PE either. So you've got to have a fixed place of business to have a PE. As I said, subsidiaries can be agents, and an agent can cause you to have a PE. The key to agency is authority to bind the principal. If the agent has authority to bind, you have risk of a PE. If the agent does not have authority to bind, then you don't have risk of a PE. Now, I've had a lot of colleagues and clients over the years that said, I'm going to avoid having my sub be a PE for me by just not letting them finalize the contracts. All the contract approval is going to happen at the head office out of the country. And a colleague of mine, Paul Bodner, many years ago, had the perfect retort to that. He said, what I do is I ask the operations people, what would you do to a salesman who said, I'm sorry, the head office is closed. I can't sign a contract that's binding. What would you do if the customer said, well, if you can't sign the contract that's binding, I'm going someplace else? Well, the executive almost always says, I'd fire the salesman. So right there you have a statement by an operations person that that salesman is indeed going to be an agent because the company is going to honor that contract. Now, doing it once or twice doesn't matter. If you do it once or twice, okay, so big deal. It has to be habitual and regular. Now, regular, I'm not sure what regular means, but habitual means you do it fairly often. So if you've got a sub binding you to sales contracts or looking like they do, and you're not saying, no, we're not following that to some customers on a pretty regular basis, turning down those customers that the sub signed up, then you probably have a permanent establishment as a result of that subsidiary having a permanent establishment. There's kind of a theoretical question here. Can a sub be independent and qualify as an independent agent? Well, in the video, I actually used an example of a sub with 18 different customers. And the key to independence is economic independence. If the subsidiary is economically independent, if it is independent in its action, and that can be tough, then it might be an independent agent, but it better have some other customers. If you're 50% or more of its customer base for generating its revenues, then or its principal base, then IRS is almost certainly going to treat it as a dependent agent. And we'll talk more about agencies a little later. So the treaties always say that you get taxed on now this isn't in the PE article, it's on the business profits article. They say you get taxed on the profits properly attributable to the permanent establishment. Well, what does that mean? I don't know. Nobody seems to know. Maybe it involves 482 concepts, as if that agent were an unrelated party. Certainly, if you take that approach, you have a better chance of winning than if you do something else. But, here you're treading on thin ice. Your best bet is avoid having the PE. Once you have a PE, well, document carefully what gets attributed to that. There's a new beastie in a lot of our treaties now, and beastie is really the right word for this because these things are the simplest of them are beasts. Limitation on benefits articles. Now let me give you an example of why you might feel, you as a government might want one of these limitation on benefits articles. Let's say you have an Oman individual, that's OMAN, the country. Nobody has treaties with Oman. And that Omani individual owns a Swiss company, and the Swiss company owns a U.S. company. And the U.S. company pays a dividend to the Swiss company. What's the withholding rate? Well, under the Swiss-U.S. treaty, it's 0. But why should just sticking a Swiss sub in there suddenly change the tax rate from 30% to nothing? Treasury started doing something about that in the early 90s, and the very first of these limitation on benefits articles was with the country where we felt, the government felt there was the most exposure, the Netherlands. And the Dutch thought about it and finally agreed to it after much haggling and negotiation and being typically Dutch. And they finally realized that they really liked this. So Netherlands has over 100 tax treaties, and this limitation on benefits clause or article is cropping up in most of theirs. We did the same thing with the UK, and they started adopting it, but they had some reservations about it. So the limitation of benefits articles say you have to look through an ownership structure to see where the ultimate ownership is. Now, if going all the way up the chain is no change in tax over not having those intervening subsidiaries, then who cares? There's no change in tax. Nobody saved any money, no big deal. Where you have an individual that's eligible for a treaty up at the top, not someone from Oman, but say someone from Germany owning that Swiss company, no problem. Even though there is some reduction in tax from having a company rather than an individual. That's something the Swiss get to tax when it goes out from a company to an individual. If you have a publicly traded company up at the top, that's fine too. It's where you have another company somewhere in there that has other owners that don't qualify for treaty benefits that you run into problems. We've got more than 30 different, and I emphasize different, limitation on benefits articles floating around out there. Some they're not only different in what they cover and how they go about it. Some of them are long, some of them are short. If you thought treaties were different on other respects, wait till you read these. So if there is a potential that there might be owners up the chain that don't qualify, that aren't resident of the same country or resident of the EU, which is for most of these treated as one country, then you really better start asking some very personal ownership questions of your U.S. company paying a dividend or the foreign company paying a dividend or interest or royalties or avoiding tax under a permanent establishment clause. Ask very personal ownership questions. And then you also have to look at another aspect of these things that is called the base erosion test. Under the base erosion test, the idea is to prevent having some company in the middle that qualifies, that's spending all its money paying interest to people that don't qualify, or royalties, or rents. So this base erosion test can be a killer even where you think you qualify. I've encountered cases in trying to analyze these limitation on benefits situations that took more than 30 or 40 man hours to resolve whether we qualified for treaty benefits. So, did I say always read the treaty? Always read the treaty and the limitation on benefits article. So at the 30-minute mark now, that's all we're going to talk about on treaties. Here, let me make sure. Yes, we're at the end here. Questions about treaties, whether it's these things I've covered right now or anything else. Questions? Any questions? Okay. What I'm going to do is stop recording. Well, I don't know whether I dare stop recording. I will continue recording. I'm going to take about a 30-second to a minute stand up and stretch break here and have a little of my iced tea. And then we'll start in on the next topic, agency. And I'll cue that up. Okay, we're back. I decided to switch over to widescreen so you can see things a little better. Hopefully not too distracting to change like that. Let's talk about agency. You've all certainly had business law, and the business law professor droned on in a monotone talking about agency and principal relationships, and you fell asleep several times. I did. uh, we're, that business law professor almost certainly did not cover some of the things you need to know. So in this session, in this part of this session, we're going to talk deep background. This isn't for the record. I'm the special source that's unnamed on learning about agency. So let's talk about what we need to know about agency for international tax. Now here I have some notes, but I'm not going to give them to you. Let's go to the board here. The basics of agency. Let's do it this way. The basics of agency. We'll talk about first the three parties you have to have for agency. An agency relationship is one in which somebody does something for somebody else, and the somebody else is bound by the actions of the first somebody. So let's have some official terms here. An agent is the one who acts. The principal is the one on whose behalf the action is taken. And to have agency, we have to have third-party reliance. If we don't have all three of these things, an agent who is acting, second, on behalf of some principal, and third, a third party relying on that action, then we don't have agency. If the third one is missing, it's kind of irrelevant whether agency is there or not because nothing happened. I kind of like to bring up a little agency story from Texas family law. I used to live in Texas for a lot of years. And in Texas, when they reformed the family law back in the early 70s, they made a couple of key changes to it and made it kind of like partnership law. You get married in Texas. Texas is a common law state for marriage. You get married in Texas by representing to other people that you're married. So if you go into a hotel with somebody else and sign in as husband and wife, you're married. Now this can cause bigamy problems. So, just don't do that in Texas. The key here is for tax purposes, an agency relationship can cause U.S. tax. Now, agency is a very old UK common law principle. Dates back to the 12 or 1300s, way, way back. And it's very much a key part of the employer-employee set of relationships. Way back, it was called master and servant, where the principal was the master and the agent was the servant. And it gradually evolved into being something significantly more than that. So the key to agency is that, as I mentioned earlier, is that authority to bind. If the agent does not have the authority to bind the principal, then there's no agency by definition. The principal has to be bound by the agent's actions. I've gotten myself lost here. A representative is not an agent. A representative doesn't have the authority to bind the principal. And my favorite thing to use here as an example is a real estate agent. They call themselves agents, but are they? When you engage a realtor to sell your house, do you give that realtor the authority to sign the contract of title over to the buyer? No. So a real estate agent's not an agent at all. They're a representative. So let's go back to the board. Key aspect of agency is the power to bind. If somebody tells you so-and-so is an agent, start asking them questions to find out whether that agent can really bind the principal, make the principal liable for contracts. Now, there are several excuse me, there are several varieties of agency that may be quite relevant here. First, there's express agency. That's where there's an agreement, verbal or written, doesn't matter, an agreement between the principal and the agent that the agent is going to act as an agent. There's also implied agency. If the parties act like the agent is the principal's agent, if they act like the agent has authority to bind the principal, to contract for the principal, to cause other people to do things for the principal and then count on getting paid, then that generates agency. And there's also agency by ratification. Ratification means the principal says, yeah, I'll go along with that after the fact, even though no agreement of agency existed and neither the third party nor the agent were really relying on there being agency. They just hoped it would come out okay. If the principal says, okay, I'm good with that, then there's agency. Now, there are a few requirements to have an agreement for agency. And I'll kind of scroll down here a little bit on the screen so you can see them. We're not going to go over these very much because things like competence to act, a few of these things are inherent in individuals rather than companies being agent. Competence means legal competence, not ability to actually accomplish something. For instance, a minor, a 16-year-old, is considered incompetent for being an agent because they don't have contracting authority. Their authority to act on behalf of the principal is kind of a key thing here. If the agent represents to the third party that he is the agent, then what if there is no agency relationship? Other than the fact that this purported agent lied and he can get sued, the third party can sue the agent. If there was no agency and the principal can prove it, then the third party's stuck just suing the agent, can't sue the principal. But if the principal then says, okay, that's good, and then decides later that it isn't good and wants to get out of that contract that the agent signed, then that third party can sue the principal because there's been ratification. The holding out of being an agent, like I hold myself out as being a CPA, same phrase here, same meaning here. Holding oneself out to be an agent for somebody else gives rise to actual agency if the principal finds out about it and doesn't do anything. Now, if I hold myself out to be excuse me, I hold myself out to be Bill's agent for selling some goods, and Bill delivers the goods after I've sold them, then the agency exists, and it's been ratified. Uh, if Bill shipped the goods. If I hold myself out as being Bill's agent to ship goods and Bill finds out about it, for instance, I run a full page ad in the New York Times saying buy the goods from me, and Bill does nothing about it by suing me or taking some other action, like publishing a really little ad in the New York Times saying Steve's not my agent. If Bill does nothing, then we have implied ratification. So there's some real toughies connected with this. Before we move on, though, let's talk about an agent that doesn't disclose he's an agent. He just is. The principal and the agent agree. Bill and I agree I'm going to sell Bill's goods. And I go out and sell a bunch of Bill's goods, and he delivers them. And I don't tell the customer that I'm Bill's agent. I represent that I have authority to sell the goods, which I do. Well, who can sue who here? Certainly Bill and I can sue each other, but since the third party didn't know about the agency, the third party is limited to suing me. Now, this undisclosed agency gives rise to a nifty little thing in civil law countries. Now, we're a common law country. In civil law countries, there's a thing called a commissionaire. And toward the end of at the end of the course, if we want to do an optional segment on disregarded entities and other fun things, then we'll talk a little about commissionaire. But that's a little bit more advanced concept. A commissionaire is an undisclosed agent that the customer thinks is acting on his own. And in civil law countries, that isn't agency, so it doesn't cause a PE. But in common law countries, US, Canada, UK, Australia, Hong Kong, it does cause a PE. Now, okay, we got this agency relationship. What does it mean? Well, it means the agent's activities are attributed to the principal. Not just the activities. That if the agent has a permanent establishment, that gets attributed to the principal. So if I'm in the US and Bill's a UK guy, and I'm selling his goods, and he's the only person I'm selling for, and I'm his agent, and everybody knows it, then Bill is taxable in the US on those sales, and the treaty isn't going to get him out of it. Now, if Bill and I are unrelated, and I've got 20 other organizations that I represent, then under the PE clauses of treaties, Bill doesn't have a permanent establishment in the U.S. because of me. He may otherwise, but doesn't because of me. So he doesn't have tax in the U.S. This is really, really important. Let me catch up with myself. Let's go back to the board here. So the acts and permanent establishment of an agent are attributed to the principal. Okay, you say, now we've covered all this. Great, Steve. So what law can I look to? Where is it in the U.S. Code? Where is it in some state law that all of what you said is true? And my answer is nowhere. This is common law. It's been around longer than our combined ages. The cases establishing agency are usually Queen's Bench cases, back from when the House of Lords was first established as both a legislative and judicial body. and the Queen's bench resolved cases that the judges had resolved and got appealed to the Queen's bench. There's no state or federal law covering agency. Now, some of the states have some laws regulating agency, but the mere existence of the agency is a common law principle. One really important thing we've got to remember is that partners are agents for a partnership, and partnerships are agents for partners. There's a book I came across a while back, Partnership as Agency. It's an excellent book, fairly short as law books go. It's only a few hundred pages. There's a Horn book on partnership as agency too. It's not short. The whole concept of partnership is agency. Partnership isn't anything except agency. If you are a partner in a partnership, all of the activities of the partnership and all of the permanent establishments of the partnership are attributed to you. If the partnership has an office or a place of business in the U.S., then you have a place of business in the U.S. And all the fighting in court won't get you anywhere on that. If you are a partner, you generally, if you're a general partner in a partnership, generally you have authority to bind that general partnership or that partnership to contracts. So you're an agent for the partnership, and the partnership is an agent for you. This is critically important in the international area, and it's often kind of neglected. So keep this in mind anytime you're dealing with partnerships. Also, based on what I've just said, it should be obvious that if the partnership has effectively connected income, then you have effectively connected income. We talked a little bit about selling agents versus sales representatives. I don't think I want to dive into this anymore. I also gave you my example on avoiding agency, but now I want to talk about ways you can avoid agency. First, sell the goods to the subsidiary. Don't sell them yourself. Make the subsidiary your customer and not your agent. If they're your customer, then they cannot be your agent for that particular item of goods that they purchased. They're your customer, and there's a key difference here. If you keep title to the goods all the way through the sales chain, you run the risk of a permanent establishment where those goods end up. So if you sell the goods from manufacturing company to sales company, then you've separated the two things very effectively. That's the number one way to avoid agency. Now, how long does the U.S. distribution company have to keep the goods in order to have in order for them not to be your agent as a foreign company? Well, not very long. I prefer that it be at least from when it goes from the door on the back dock to the door on the truck, 20 feet away, that subsidiary owns the goods. Doesn't have to be anything other than just momentary transfer of title. Oh, but it's so much paperwork. This is the age of computers. Computers do paperwork fast. Invoices don't even have to have carbon copies anymore. You just have a computer program that pings out various records for it. So you can have this chain of sales without any real transfer of substantial economic risks because the ownership is very momentary. If you're selling munitions and they blow up on the forklift while your U.S. sub owns them, well, then the U.S. sub has some liability. But that's what they make insurance for. Key way to avoid agency is sell the goods to this company that might risk being your agent. But I can make the agent independent, right? Well, maybe not. If you have an independent agent, the activities, the income, the PE are not attributed to you. But what is independence? Well, the key thing is entrepreneurial risk. If you stop being that person's principal supplier, do they fail? And if the answer to that is yes, they're not economically independent, and they're potentially your dependent agent. How much control can you, not do you, can you exercise over that agent? I've had the argument in transfer pricing cases made to me by clients, laughed at by economists, of course. But we negotiated that contract independently. Well, if it was your subsidiary and the CEO negotiated provisions that you, as the board of directors of the parent company, didn't like, what would you do to that CEO or that officer of the subsidiary? You'd fire him. So he's really independent, right? Yeah, right. A key thing you have to remember in agency is there doesn't have to be an equity relationship here for the agent to be dependent. If the agent is economically dependent, whether there's ownership or not, if you're his only supplier and he's economically dependent, then he's a dependent agent, not an independent agent. And we covered this already. So we're right at 7:10 when I promised I would finish. Questions? I don't think I've got anybody muted here. In case I have, type things in chat. So I'll keep it open for about a minute and a half here unless I get questions.